Gearing up for the jobs report out tomorrow, economists expecting another good month of job gains, north of 200,000 for the month of March. But the Federal Reserve's rate increase looming closer and closer. People are still wondering if, in fact, that is going to materialize later on in the year. Joining me right now is Grant's Interest Rate Observer founder and editor, Jim Grant. Jim, it's good to have you on the show today.
Thank you, Maria.
Thank you so much for joining us. I know you don't have a specific expectation for the jobs number tomorrow, but give us your sense of the economy broadly speaking. You mentioned during the commercial break a report that the Atlanta Fed does regularly.
Yes, the Federal Reserve Bank of Atlanta updates its projection as to the current quarter's rate of growth or lack of growth based upon every incoming datum. Every economic release tweaks something in the Atlanta Fed's GDP forecasting model. So it started out expecting 1.9% growth in the first quarter, and now, as of yesterday, it was down to 0% growth.
Wow.
Yeah.
What happened? Is it the strong dollar?
It's what didn't happen.
Yeah, what didn't happen, exactly.
Well, strong dollars are certainly weighing on exports. The extreme wintry weather certainly weighed on other things in the first quarter. But, you know, economic activity is weak.
What do you think that means for the Federal Reserve? I mean, if economic activity is weak and we see that, you know, GDP is going to get smashed for the first quarter and we're going to see zero number, which a lot of people are expecting at least a one handle, how can the Fed raise rates?
Well, I think the Fed is going to, actually, I don't think the Fed is going to raise rates. At least it will, I suspect, in our lifetime. But
not in 2015.
I don't think so. And I think the reason for this is, for one thing, the dollars, the cost that the dollar is exacting on American exports and on the earnings of big blue chip American companies. You know, the Fed's actions and the European Central Bank's actions constitute kind of a zero-sum game. The European Central Bank has been very, very aggressive in buying up bonds, and you can see this in the phenomenal, almost incredible yields attached to some of these sovereign debts in the continent of Europe. German bonds yield not zero exactly, but not so very much more than zero that you'd notice. In 2 consecutive days, a couple of weeks ago, German bond yields fell in excess of 20%, 2 days running.
Look at this chart of the German 10-year. It's unbelievable. We're talking about a rate of 0.17
right,
on the German 10-year.
So this is the siren of depression, right? No, because the German equities, the so-called DAX index, is within a hair's breadth of its all-time high. So the European Central Bank buys bonds hand over fist. The euro exchange rate against the dollar collapses, export earnings boom, and Europe has this curious alignment of market forces, stocks as if there were a great boom, bonds as if there were a great depression. So across about 3,000 miles of water, what you have is a so-called strong dollar, strong against the euro, and you have very weak export earnings, and you have a stock market that did nothing in the first quarter. So Ben Bernanke was, in his maiden blog post the other day, said that central banks actually do not control interest rates. Well, maybe not exactly, but what they do is manipulate them substantially in the here and now. And the first quarter, I think, is most eloquent testimony to the meddlesome consequences of these central bank actions.
How much of this is priced into the market? I mean, we've all watched yields move lower, and we've all watched the dollar move higher. But when you're talking about a zero number as it relates to GDP, and when you're talking about earnings that are actually going to be negative, revenue is going to be negative for a couple of quarters for 2015, will this act as a surprise when these numbers come out and cause a sell-off?
I'm not sure how much of it is priced. And let's take one sector, for example, the biotech sector. Now, Janet Yellen singled this out in July of 2014 as part of the market with valuations, quote, substantially stretched. And someone the other day said, well, what about it? And she said, next question.
Right, so
it was like up in her face, and she said that as markets do go up in one's face after one says something bearish, right? Mm-hmm. Okay, so as of the moment, there are 150 stocks in the NASDAQ Biotech Index. About 119 or so have shown no earnings in the past 12 months. The index as a whole trades in excess of 400 times on average trailing net income.
400 times,
yeah,
huh?
Right, so that sector of the market would seem to be still, as the chair put it, substantially stretched.
And look at that chart of the NASDAQ Biotech.
Yeah.
Let me ask you about sort of riding this through. I mean, if this is not priced into the market, then we could see a sell-off in stocks as it becomes apparent that the economy has gone nowhere in a short period of time and earnings are actually getting severely hurt by the dollar. Are there areas to hide in an environment where we were to see a big sell-off in stocks? What do you like and how do you allocate capital here?
Well, I mean, there's nothing wrong with holding cash, which is the thing to have when opportunities are looming but not present. In expectation of no interest rate increase this year, in expectation of perhaps a reversal by the Fed of its promised stance to tighten, I am currently in love with a stock called Barrick Gold, ABX, which is thought to be the weakest big gold producer in the world, but I think in fact is on the way back to redemption. It's very leveraged. It kind of soiled it's blotted its copybook a couple of years ago by borrowing a lot of money to buy a copper mine. The gold investing world has no use for it, but it has the best and safest gold properties in North America, and I think that the management now is determined to turn things around, and it is doing so. And
you certainly have a valuation story that is better than others. The stock has come all the way down. You think that that's a catalyst for actually getting in?
Well, it is on the outside looking in. It's the best house, I say, on the worst block. It is perceived to be the worst house on the worst block. People have no use for gold. They have less use for Barrick. I'm thinking that gold will come back and that Barrick will come back as the most leveraged play on that projected return of the gold bull market. But this is, I mean, need I say, this is guesswork as opposed to science.
Sure. Well, listen, it's all about expectations, and you've laid it out quite well. Jim, great to see you as always.
Thank you, Maria.
Thank you so much. Jim Grant is editor, founder, Grant's Rich Interest Rate Observer. Now,